Okay, welcome to the deep dive. Today we're getting into multi-bagger stocks.
Right.
Those investments that can, really take off maybe 100% return, sometimes way more in just a few years.
Yeah, the dream stocks, basically.
Exactly. And our mission, well, our aim today is to unpack what these top performers have in common. We're digging into historical data, NSE, BSE,
Mhm.
and there's that Goldman Sachs study too, right? Looked at over, what, 250 Indian multi-baggers?
Yeah, 269 over 2 decades, plus insights from, various experts online.
So the goal is to give you, the listener, a clearer idea of what to maybe look for without it feeling like homework.
Precisely. It's about finding those recurring patterns.
Mm.
What's really interesting is how often the same kind of traits pop up in these exceptional companies.
Okay, let's dive in. Growth seems like the obvious place to start. Multi-baggers grow fast, clearly.
Right.
But the numbers are pretty specific. Goldman Sachs found like a majority hit at least 20% sales growth.
Yeah, 20% sales and, crucially, 30% profit growth. That combination is powerful.
Think about persistent systems. Their numbers were huge, weren't they?
Oh, absolutely. Something like 163% sales growth, 95% profit growth over just 3 years.
Wow.
That's the kind of trajectory we're talking about.
So why is that kind of rapid, sustained growth so critical? It's not just a one-off spike.
No, exactly. It signals really strong demand for what they do and a business model that can actually handle that growth, that can scale effectively.
Right.
So if you look at the data points, you want that high KGR, compound annual growth rate, for both sales and profit. Say over 20, 25% for sales, maybe over 30% for profit, looking back 3, 5 years.
Okay.
And seeing revenue climb steadily for like 8, 10, 12 quarters or more.
Yeah.
That shows real momentum. It's not just, flash in the pan.
Got it. So big growth numbers sustained over time. But it's not just about getting bigger, it's how smart they are with their money too, right? Things like return on equity, ROE.
Exactly. ROE, ROCE, return on capital employed. These metrics tell you how efficiently a company is making profits from the money shareholders have invested or from all the capital it uses.
And the good ones are usually high.
Generally, yes. The Goldman data showed most multi-baggers had ROE and cash ROC above 15%. And interestingly, for about 75% of them, the ROE was actually increasing.
Oh, okay. So it's not just high, but getting better.
Right. That upward trend is a really positive sign. Some experts even screen for an average ROE over 5 years that's above 20% and ROCE over 15%. It shows fundamental strength.
Makes sense. Okay, another thing that seems to stand out is debt, or rather, the lack of it.
Yeah, that's a big one. Low debt, or being nearly debt-free, provides a much more stable foundation.
Less risk, I suppose.
Definitely less risk, and it gives them more freedom. They can seize opportunities, invest in growth, weather downturns, all without being dragged down by huge interest payments.
Like persistent systems again?
Yes, they're a good example. Or Syngent, very low debt to equity.
Yeah.
Generally, aiming for a DE ratio below 0.5 is a pretty common recommendation you see. It suggests financial prudence.
Okay, switching gears slightly, what about the people running the show? The leadership. We saw high promoter holding mentioned often.
Yes, that's another interesting pattern. When the founders or the main promoter group hold a large stake, often over 50%.
Why does that matter so much?
Well, the thinking is it aligns their interests more closely with other shareholders. They have significant skin in the game, suggesting, a long-term commitment to the company's success. Think of historical examples like Reliance or Wipro.
Right, strong founder influence. And the business itself, the market it's in, that has to be solid too.
Absolutely crucial. You need a strong competitive advantage, a moat, as they sometimes call it.
Okay.
And ideally, they're operating in an industry that's growing overall. Think about companies leading their niche, like alkylamines or pelagiamines in their segment.
Or tapping into big trends like Tata Elxsi with AI and EVs.
Exactly. Or M&M dominating in SUVs right now. Or HAL in defense aerospace. That market position and industry tailwind really help.
So good business, strong leadership, low debt, high growth. What about the price you actually pay for the stock? Does it have to be cheap?
Cheap is relative. But yes, attractive valuation often plays a role, especially early on. They might not look like screaming bargains based on current earnings sometime,
Okay.
but they're often undervalued relative to their future growth potential.
Hmm.
We saw some analysis suggesting that the PE ratios of many multi-baggers increased significantly after they started their run, implying they were relatively cheaper initially.
So maybe looking for things like a PEG ratio below 1 or a PE that's lower than the industry average?
Those can be useful filters, yeah. It's about finding that potential before everyone else does.
And it often seems like these start small, don't they? Like small or mid-cap
That's
companies.
very often the case. It's just, well, easier for a smaller company to double or triple in size compared to a giant.
Makes sense. More room to run.
Right. Goldman found that a large chunk of the really big winners, the 10 baggers, started out as small to mid caps. Some suggest focusing on companies maybe below, say, 3,000 crore market cap for that explosive potential.
And looking forward, innovation must play a part, being future ready.
Oh, absolutely. Companies investing in R&D, adopting new tech, scaling effectively like Tata Elxsi in design and tech services, or Syngene in biotech R&D, they're positioning themselves for that sustained growth.
So we've covered quite a bit. Strong growth, efficient capital use, low debt, committed leaders, competitive edge, valuation, size, innovation.
And good governance, effective management too. That underpins everything.
Right. It feels like it's rarely just one thing, is it?
No, definitely not. It's usually a combination, a confluence of these factors. Strong fundamentals meeting smart management in a favorable market. No single trait is a magic bullet, but these are the themes that keep showing up in the data.
So the takeaway for you listening isn't a simple checklist, but more a framework for thinking. As you consider long-term investments, maybe keep these fundamental traits in mind.
Exactly.
And here's a thought to leave you with. What companies out there right now, maybe flying under the radar, might actually possess this kind of potent mix? It's about looking deeper, isn't it?
It really is. Looking for those future stories hidden in today's market.